$1. That is all it takes. One single dollar over a line you probably do not even know exists, and Medicare quietly adds over $1,000 to your annual premium bill. Not because you did anything wrong, not because you cheated or lied or missed a deadline, because you went $1 over a number that nobody told you about. And here's the part that should genuinely stop you cold. That $1 you spent 2 years ago is the reason your Medicare bill is higher right now, today. I am going to say that one more time because most people hear it and still do not believe it. The income that decides what you pay for Medicare this year is not your income from this year. It is your income from 2 years ago. A withdrawal you took, a property you sold, a one-time decision that felt completely reasonable at the time. That decision is sitting quietly inside your 2026 Medicare premium right now. And if you cross the line by even $1, the entire penalty landed on you all at once, not a fraction, all of it. That is what we are going to take apart today. And by the time this video is done, you are going to know exactly where that line is, exactly how ordinary retirees fall off it without ever seeing it coming, and exactly what you can do right now to protect yourself. Whether you are already paying a surcharge you should not be paying, or you want to make sure you never start. Before I go one sentence further, my name is Jack, and this is Jack Retires. This channel exists to take the rules that quietly cost retirees money and explain them in plain English before they hit your bank account. I am not a lawyer, I am not a CPA, I am not your financial advisor. Everything here is educational, based on 2026 Medicare rules and public information. Your situation is your own, so always confirm with a professional before making changes. If this is your first time here and you want to know about these traps before they catch you instead of after, hit subscribe right now and tap the like button while you are at it. It costs nothing, it takes 2 seconds, and it is the only reason this information reaches the next retiree before they make a decision that follows them for 2 years inside their Medicare bill. Now let me tell you about Richard, because Richard's story is not unusual. It just feels that way until you understand the rule nobody bothered to explain. Richard is 68. He retired 3 years ago after a long career as an electrical engineer. He has a pension, he collects Social Security, he pulls from his IRA when he needs to. He is careful with money, tracks every dollar, never late on a payment in his life. And 2 years ago, his daughter was buying her first home. Richard helped with the down payment. He pulled $38,000 from his traditional IRA to make it happen. It was a one-time thing, a gift from a father who had worked his whole life to be able to do something like that. He paid the income tax on the withdrawal. He moved on. He did not think about his Medicare premium because why would he? Nobody connects those two things for you. The bank does not say anything when you request the funds. Your IRA statement does not come with a warning label. Richard simply helped his daughter, filed his taxes, and forgot about it. Then 14 months later, a letter arrived from Social Security. His Medicare Part B premium was going up, not a small adjustment, by $81.20 a month, every month for the entire year. That is $974.40 in additional Medicare costs, triggered by a withdrawal Richard had practically forgotten from a year that felt like it was behind him. And here's the detail that made Richard angriest of all. If he had taken out $37,999 instead of $38,000, the surcharge would not have applied. $1, one single dollar. The difference between a normal Medicare premium and nearly $1,000 in extra charges was $1 he did not know he was crossing. And I want you to stay with me here, because the thing I'm about to explain is the reason this happens to so many people who are doing everything right. There is a surcharge built into Medicare called IRMAA, Income-Related Monthly Adjustment Amount. The name is deliberately complicated, but the concept is simple. If your income climbs above a certain line, Medicare adds a penalty on top of your standard premium, and it is not a gentle slope. It is a cliff edge. Cross it by $1 and the full surcharge hits you immediately, every penny of it. In 2026, the standard Medicare Part B premium is $202.90 a month. That is what most people pay. But the moment your income goes $1 above $106,000 as a single filer or $212,000 as a married couple, your premium jumps to $284.60 a month. That is $81.70 extra every month for 12 months for crossing the line by $1. And it does not stop there. Because there are 5 tiers and the numbers get painful fast, If your income lands between $133,000 and $167,000, your monthly premium goes to $391.90. That is nearly $2,300 more per year than your neighbor who earns $1 less. Between $167,000 and $200,000, your premium hits $499.20 a month. And at the top tier, a single retiree pays $628.90 a month for the exact same coverage someone else is getting for $202.90. That is over $5,100 a year more for identical coverage, triggered entirely by where your income landed. Now pause on that for a second, because I do not want you to miss what is actually happening. This is not a penalty for being rich. At $106,001 in income, you are not rich. You are a retiree who had a slightly higher year and crossed an invisible line that nobody pointed out, and now you are paying nearly $1,000 more for Medicare than the person living next door. Every year that income number stays high. That is the cliff. That is what makes this rule so dangerous for ordinary retirees who are just trying to manage their money. But here is the part that takes this from surprising to genuinely shocking. And this is the piece that catches even organized, careful retirees completely off guard. The income Medicare uses to calculate your surcharge is not this year's income. It is your income from 2 years ago. In 2026, Medicare is looking at your 2024 tax return. That is the number they use, right now, today. Which means a decision you made 2 years ago is deciding what you pay for healthcare this year. A withdrawal you took, a property you sold, a Roth conversion you did. Whatever happened in 2024 that pushed your income above the threshold is sitting in your Medicare premium right now. You may have moved on. You may have had a perfectly normal income in 2025 and 2026. Medicare does not know that yet. It is still looking at 2024. Think about Richard again. He made one withdrawal in 2024 to help his daughter. He filed his taxes. He paid what he owed. He moved on with his life. And 14 months later, that single decision showed up at his door as a letter from Social Security saying his Medicare premium was going up. The cause was buried in a tax return from a year that felt like the past. That 2-year lag is the hidden engine behind most unexpected Medicare surcharges. And if you have never heard it explained that way before, you are not alone. Most retirees only learn about it when the letter arrives. After the year's over, after the decision is made, after there is nothing left to do but pay. So let me ask you something right now. What did your income look like in 2024? If you are watching this and you are not sure, that is the first thing I want you to go check after this video, because that number is either affecting your Medicare bill right now or it is not. And if it is, I am going to show you what to do about it. But first, let me show you the 4 most common ways ordinary retirees end up on the wrong side of this cliff without ever planning to. The first is a large IRA withdrawal. You needed money for something. Maybe it was a home repair. Maybe it was a medical expense. Maybe you helped a family member the way Richard did. You took out more than usual in a single year. That extra amount landed in your income, and depending on where your income was already sitting, it pushed you over the line. The withdrawal felt like a reasonable thing to do. The Medicare surcharge that followed 14 months later felt like it came out of nowhere. The second trigger is selling a property, a vacation home, a rental, even your primary residence if the gain was large enough. The sale creates a taxable event in that year. Medicare sees the income. It does not matter that you reinvested every dollar. It does not matter that it was a one-time event. The number shows up in your tax return, and it follows you into your Medicare premium 2 years later. The third trigger is something that should actually help you, a Roth conversion. Moving money from a traditional retirement account into a Roth is one of the smartest long-term tax moves available. Done correctly over several years, it can save you tens of thousands of dollars. But if you convert too large an amount in a single year, that conversion shows up as income. And if it pushes you over the IRMAA threshold, you pay for it in Medicare costs 2 years later. The move that was supposed to protect your money can quietly cost you money if the timing and size are not planned carefully. The fourth trigger hits retirees who have no choice: required minimum distributions. Once you turn 73, the IRS forces you to pull a minimum amount out of your traditional accounts every single year, whether you need it or not. Those withdrawals are income, and if your accounts have grown significantly over the decades, the required amount can be larger than expected, larger than you needed to live on, and large enough to push you right over the IRMAA line, raising your Medicare costs at exactly the moment in life when healthcare is already one of your biggest expenses. Do you see what all four of these have in common? Not one of them is a mistake. Not one of them is careless. They are all things that careful, responsible retirees do, and the system quietly reaches into your Medicare premium because of them. The retirees who get hurt the most by IRMAA are not the reckless ones. They are the ones who saved well, made reasonable decisions, and simply never knew the cliff was there. Now, I am not going to leave you with just the bad news, because there are real things you can do right now, this week, and I'm going to walk through all of them. The first and most important move is to know your income before the year ends. Not after, not at tax time, before December 31st. Every fall, sit down and estimate your total income for that year. Add up your Social Security, your pension, your required minimum distributions, any IRA withdrawals you were planning, any investment income, anything else. Then compare that number to the IRMAA threshold, $106,000 for a single filer, $212,000 for a married couple. If you are within $5,000 or $10,000 of that line, you still have time to act. Pull a smaller withdrawal this year and take the difference in January. Spread a Roth conversion across 2 calendar years. Small adjustments before December 31st can mean the difference between a normal premium and nearly $1,000 in extra charges. After December 31st, the number is set. There is nothing left to do but pay. The second move is something called a qualified charitable distribution. And if you give to charity and you are 70 and a half or older, this one is genuinely powerful. A QCD lets you send money directly from your IRA to a qualified charity. That transfer counts toward your required minimum distribution for the year, but it does not show up as income on your tax return, which means it does not count toward your IRMAA calculation. If you have a required withdrawal of $20,000 and you send $10,000 of it directly to your church or a charity you support, only $10,000 appears in your income. The other $10,000 satisfied your withdrawal requirement without ever pushing you closer to the cliff. Same gift, same withdrawal satisfied, but a completely different result for your Medicare premium. The third move is to plan Roth conversions in tiers, not in round numbers. Most people pick a number and convert it. That is the wrong approach when you are anywhere near an IRMAA threshold. Convert up to the line, not over it. If your income before the conversion is at $90,000, you have roughly $16,000 of room before you hit the $106,000 threshold. Convert $15,000, not $20,000, not a round number, the number that keeps you safely under the cliff. Then do it again next year and the year after. Small, controlled conversions over several years beat one large conversion that pushes you into a surcharge tier. Now here's the fourth move, and this is the one that almost nobody knows about, but it is the most important one for people who are already paying a surcharge they should not be paying. It is a form called SSA 44, and it exists specifically for retirees whose income has dropped significantly because of a life-changing event. Medicare will normally look 2 years back, but if your financial situation has permanently changed, the SSA 44 lets you ask Medicare to use a more recent year instead. You fill it out, you attach proof of the life-changing event, you submit it to Social Security, and if approved, your premium gets recalculated based on your current lower income. The surcharge can drop completely, and any months you already overpaid may come back to you as a credit. Medicare officially recognizes 8 qualifying events. Full retirement is one of them. Work reduction is one. Loss of a spouse, divorce, loss of pension income. If your ongoing income is permanently changed, this form was created for you. Call Social Security. Ask about it. The number is on ssa.gov. Do not wait for someone to bring it to you. They will not. The system does not send a letter saying you might qualify for a lower premium. It just keeps charging you until you ask. Now let me come back to Richard, because his story does not end with the letter. A family member told him about the SSA 44. Richard had retired in 2023. That retirement qualified as a work stoppage, which is a recognized life-changing event. He called Social Security. He submitted the form with a letter from his former employer confirming his last day of work. Medicare looked at his 2023 income instead of his 2024 income. His 2023 income was well under the IRMAA threshold. The surcharge was removed, not going forward only, retroactively. A credit was applied for the months he had already overpaid. Richard got money back. Not because he found a loophole, because the form existed, the rule existed, and someone finally told him about it in time. That is exactly why this channel exists. The forms are real, the rules are real, the tools to protect your money are real. But if nobody walks you through them in plain English, they might as well be invisible. The retiree who knows about the SSA 44 keeps their money. The retiree who does not sends it to Medicare month after month and never knows why. Let me give you the 5 things I want you to do this week. Not eventually, this week. First, pull out your 2024 tax return. Go to line 11 on Form 1040. That is your adjusted gross income. Compare it to $106,000 for a single filer or $212,000 for a married couple. If you are above that line, you are likely already paying an IRMAA surcharge on your current Medicare premium. Second, check your Medicare statement. The standard Part B premium in 2026 is $202.90 a month. If you are paying more than that, your statement will show a line called IRMAA adjustment. That line tells you exactly how much the surcharge is and which tier triggered it. Third, if your income has dropped since 2024 because you retired or reduced your work or had another qualifying life change, call Social Security this week and ask specifically about Form SSA 44. Bring a letter confirming your retirement date or your last pay stub. Ask whether you qualify. Do not assume someone will notify you. They will not. Fourth, if your income this year is anywhere near the $106,000 threshold and the year is not over yet, estimate your total income right now. See how close you are to the line. If you have flexibility, make decisions before December 31st. After that, nothing can be changed. Fifth, if you give to charity and you are 70 and a half or older, ask whoever manages your IRA about setting up a qualified charitable distribution before year end. Every dollar that goes straight from your IRA to a charity is a dollar that does not push you toward the cliff. 5 actions. None of them take more than a phone call or an afternoon with your own paperwork. And together, they could be worth $1,000 a year or more in Medicare costs you were never supposed to pay in the first place. Before I let you go, I want to ask you 2 things, and I genuinely read these comments, so please take a second. First, which part of today's video was completely new to you? Was it the 2-year lag, that your 2024 income is deciding your 2026 Medicare premium right now? Was it the cliff mechanic, that $1 over the threshold triggers the entire surcharge at once? Or was it the SSA 44 form that can remove a surcharge you are already paying? Drop the number 1, 2, or 3 in the comments below. The answer that comes up most tells me which one to break down in a full dedicated video next. Second, tell me where you are right now. Are you already on Medicare and wondering if you are being overcharged? Or are you still planning and trying to get ahead of this before it becomes your problem? Just drop the word Medicare or planning in the comments. That one word tells me who I am making these videos for, and it shapes everything I cover going forward. If this video helped you see something you did not see before, hit that like button right now. It is the single most effective thing you can do to make sure the next Richard finds this before he gets the letter instead of after. YouTube uses that signal to decide who else to show this to. Every tap pushes it in front of another retiree who needs it. Subscribe to Jack Retires if you have not already. Every week I take a rule or a trap or a change that quietly costs retirees money, and I lay it out in plain English before it costs you. And share this video with one person you know who is on Medicare or getting close. One person, one share. That could save them $1,000 this year alone, and the same $1,000 every year after that. The cliff is not going away. The 2-year lag is not going away, and the letter from Social Security will keep arriving for every retiree who never learned where the line was. The only thing standing between them and that letter is knowing what you know right now after watching this video. So pass it on. That is worth more than almost anything else you could give someone who spent their whole life building something they deserve to keep. I will see you in the next one.